Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is Executive Director at Galileo Capital. He is also a personal financial advisor and a chartered financial analyst and financial planner. Please will you ask Warren if there's a benefit in one owning physical gold or silver? What are the benefits? Asks Rob. Warren, I'm asking. Any benefits of holding physical gold or silver?
I guess if the world and the financial system comes to an end and there's no method of being able to transact with each other with electronic money anymore, and our notes are worthless, then possibly physical gold or silver might become a method of transaction. But to me, an extremely inefficient one, because you're going to have to carry all this stuff around with you all the time and stop other people from robbing you, etc. So I'm not convinced that for most of us in our day-to-day lives that gold or silver in physical form are extremely helpful. And I think if you do find some of the kind of world's really wealthy will store some gold and silver and some other precious metals and gems in safes and vaults. And I know a lot of South Africans like their Krugerrands, but for me, it doesn't really generate interest or dividends or rent or anything. And so I think it's really for the doomsday preppers and the collectors and for the rest of us, many better forms of investments than physical gold or silver.
There we go, Robert. We're not going to spend any more time on it. Emotions. We've all had a few. Warren Ingram, do talk to me about emotions and money. When markets are going up, inflation is non-existent and interest rates are low, everybody feels like a genius because generally you start seeing economies performing very well. You start seeing jobs being created. You start seeing more people being hired. You see very positive forecasts about the future. And then you go through times like we're in at the moment and nothing feels good. Nothing feels right. Nobody is clever. Everyone's a bleeding idiot. And it's the beginning of the end of the world. I don't know if it's possible to avoid the highs and lows of emotion when it comes to money.
I agree. I don't think it's possible to not feel the emotion or to be robotic about it. I think the psychologists have studied this stuff, and we kind of get much more depressed and about losing $100 than we do get excited about making $100. So unfortunately, we tend to feel the losses and the negativity much more than we feel the gains and the positive side. But the truth is, we have to find ways as investors and whether you're professional or private investors, we're all investors. We all need to make money and one day try and live off our money. But we need to find ways to manage our emotions and maybe to take emotions out of our thinking when it comes to kind of long-term strategic decision-making. I think it's okay to kind of go home and, kick a boxing bag or, mow the lawn or whatever it is that you want to do to release the emotions, go for a run. That's what I do. But when you sit down to kind of think about your long-term investment decision-making, then you need to become as robotic as possible and as rational as possible and try and leave your emotions at the door, because unfortunately, emotions are extremely expensive when it comes to making investment decisions. We're just not programmed as human beings to make smart, sensible, rational, long-term decisions when our fight or flight kind of impulses are firing at maximum kind of efficiency. Those fight or flight impulses are really good for keeping us out of life and death situations, but unfortunately they override all logic and reason when it comes to making good investment decisions. So you're right, Bruce. I think it's really hard to not be emotional, but I think you need to develop a methodology for avoiding emotional decision making.
How then? What is the methodology? What is the thinking? How do we, as we're sitting down, we're about to sign a mandate, we're about to commit extra money in our direct debit because we've had a small salary increase and we're going to put half of that salary increase extra into our savings, all of the things you keep teaching us to and telling us to do. Yet we sit there and we go, this war in Ukraine is going to drag on for longer than we thought. The Chinese interest in Taiwan is just too scary. The US tech bubble has burst again. I don't see any economic growth coming out of Europe anytime soon. I'm worried about the recovery in China and the draconian nature of leadership in that economy. I don't like what's happened in Hong Kong. I'm worried that Joe Biden and Donald Trump go head-to-head in America next year. I'm worried that Erdogan wins again in Turkey. I'm worried that Britain's health service falls over and that affects the stability of the UK. I'm worried about Julius Malema becoming all of the things that can go wrong. And quite understandably, all of those are possible scenarios. And you expect me to abandon emotion and invest into that catastrophic mess?
So let's not deal with each of those individually.
But please no, because we'll be here for months.
Put them in a bucket, and then I'll ask you one question, which is what impact can you have on any of those events?
None. And this is why it's out of my control. And this is why I need to avoid being involved in it, because it's just, I can't control it. It's beyond my control.
And I think it's fascinating, to have these conversations now, because we're having them all the time, all of us, all around the country, and spending enormous amounts of energy on stuff which we frankly just can't control. And more to the point, we can't predict what's going to happen. We can't predict any kind of an outcome in this. When you look at all of those things you've mentioned, all of them are scary. All of them are worrying. The truth is we can try and prescribe or ascribe a certain probability to it. So we could say, well, I think there's a 90% chance that Biden and Trump go head to head. Well, okay, so let's assume you were right. Now you have to try and forecast how investors are going to deal with that. And then you're going to have to try and forecast how investors deal with the outcome of whatever that election actually, what the outcome of that election is. All of those are variables upon variables, that just eventually take you down a rabbit hole that you just will never get out of. So trying to forecast all these things and trying to predict all of them and getting too worried about them, it just leads you nowhere. And to me, the decision making is we've seen world markets and global economies and socio-political events that are similar to this hundreds of times in the last 200-300 years. And amazingly, stock markets and investment markets, before there were stock markets, there were investment markets, and amazingly, they tend to do well over decades, irrespective of all the things that people worry about, irrespective of lousy politicians.
The point. Thank you, Warren. Because, that is the point, isn't it? You look at, and I do love the graphs that some of the asset managers produce from time to time, and they show you over generally long periods of time that suit them best. But they'll go from the bottom left corner to the top right corner and then plot along a timeline. This happened here, the catastrophe at Sharpeville, the arrest of Nelson Mandela, the state of emergency, the assassination of Chris Hani, the global financial crisis. That's always quite a biggie. Then COVID as another biggie. But we look at it in the fullness of time, and you suddenly realize that nothing actually matters. Even 9/11, the dot-com bubble bursting. If you are sensibly invested and not taking enormous great punts on betting your house or your farm on a single stock, you're not putting everything into Naspers, you're not putting everything into Tencent, you're not putting everything into one bet, you are actually fairly well insulated against some of the wildest vacillations of human beings' impact on the world over extended periods of time.
Yeah, so I did a calculation today, because it's public holiday, I've got nothing better to do. So I decided to do some number crunching. And I looked at if South Africans had invested, in the average balanced fund 20 years ago, put 100,000 Rand in there, what would we have today? And your 100,000 Rand
okay,
today...
no, hold on. Whoa. Let me see if I can get this. Okay, so this is 20 years ago. So that will be 2004. The South African economy is growing at 5% in those days, and it grows at really 4 or 5% up until 2008. We have the calamity, we have the recovery, we go through the state capture years and the Zuma years, we go through COVID. That 100,000 Rand today is worth, I don't want to be ridiculous about this, but 562,407 Rand and 28 cents. I don't know, but over 500,000 Rand.
A million and 54.
I was halfway there. Okay.
You were halfway. And so, put 100,000 Rand in, take all the things that you've just spoken about. The Rand was, I think, at about 5 Rand or something, then think about it now and all the things that have happened. Your 100,000 Rand has gone to, it's 10 times, basically. It's 10 times its money. And you've done nothing. You bought the average fund. You haven't bought the best one, the worst one. You haven't decided to go all to cash because you're really worried, in the middle of the financial crisis. You haven't gone 100% to shares, when things recovered. You've just sat there and done absolutely nothing. And what you've really done, in essence, is owned a basket of investments that include shares, they include properties, they include government bonds, corporate bonds. They've got some cash, they've got some local, and they've got some global. And you've just sat back and done nothing. And that's the return that you get for doing nothing. And I think you're kind of getting the hint now, when times are volatile, do nothing, because that's probably going to make you much more money than doing something. And doing something costs South Africans in this scenario, costs them about 250,000 Rand at the end of that 20-year period. That's the cost of our behavior when we buy investments like balanced unit trusts and we decide to chop and change. Because when we do that, we actually end up doing it universally at a very bad time. We sell high, and then we end up buying even higher, and then everything falls apart, and then we sell incredibly low. And that's kind of the behavior that we've got as human beings because of these emotions. So doing nothing gets you to $1 million. Acting and listening to everyone's input and making big decisions and being very dramatic about how you're going to chop and change, and with all the forecasts and the bad news that everyone throws, shoves down your throat, you're going to end up with about 750,000 Rand. Not a bad return, but it's a huge cost for doing something, for being active, and it's a human instinct to be active. And I guess my message then is, sometimes when you've got a good mix of assets, doing nothing, kind of just shutting down the emotions and listening to it as you would if you were sitting on the moon or Mars, would help you a lot. But try not to make predictions and try not to get involved in decision making until everything's okay again. Then perhaps review when your emotions are calm and markets are okay again and economies are okay again and all the bad things you've been worried about have passed. Then you can say, well, let me review my strategy. Perhaps it's time to change. But don't change in peak emotion, whether it's peak euphoria or peak pessimism, which I agree, we're in it now, because most likely you're probably in the right place. You just need to wait and be patient.
Easier said than done, though, Warren. I mean, you deal with the psychology of money each and every single day. You've got people who no doubt are emotional about their money, people who have perhaps stopped working, who don't have the comfort of knowing there is ongoing income to live off while markets sort themselves out. These are people who are going to be dependent on that amount of money that they've got. They need it to grow in value so that they could draw down some of it over an extended period of time.
Yeah, you're right, and it's not just kind of thoughtless words that we kind of sprouting on the radio, hoping to get some listens. We're trying to impart in some instances decades of research, learning, experience, maybe centuries of research into this, and hoping that people listen, at the time when they need to hear it most, which is exactly that group you're just speaking about now. The people that are sitting at home, living off their asset base with little ability to generate new income because they've stopped work or they can't work. We're really talking to you now and to say, just stay the course, just stay with it. We're not just saying the stuff because it's fun to say, or we've got nothing else to do. This is really for your benefit. We want you to listen and learn and get to the good outcome, get to the R1 million after 20 years and not the 750,000.
Now, an email from Donovan and Sally. We need your insights, please. We'll be turning 60 in 2 years. We plan to retire at that time. We have a nice home, but it's too big for a retired couple. We plan to sell it and go for something lower maintenance and running costs. This will lower the income we need in retirement and put some extra cash in the bank. We're not sure if we should move into a retirement village or just buy a smaller house elsewhere. What do you think we need to do what do we need to think about? Oh, my goodness me, it's late. To make a good decision. Is renting a good option for retired people? What an interesting thought. Warren?
I think there are a couple of big questions there. So one, downscaling your house and reducing your cost of living, at the right time is critical. So I think, where you are in a position to sell and spend less on maintenance and rates and all those things, I think that's an incredibly good decision, and you should do that as fast as possible. If you haven't made up your mind in terms of, actually moving into a retirement village and the like, then taking time, by moving into a rented property for, a year or two or three, to me makes a lot of sense while you figure these things out. I don't think you need to kind of rush from, the house you've lived in for the last 20 years and then, immediately buy in a retirement village and then realize you absolutely hate it. Or conversely, you move to some tiny little village because that's what everyone else is doing and you hate that even more. I think, renting when you are able to do so makes sense because, you can pack up at the end of that lease and move along and make some informed decisions. Moving into a retirement village, I think, for some people that's an abhorrent concept. They have this kind of image that it's, a self-created prison. I think, nowadays you kind of get, beautiful retirement villages, which are no different to any other estate. And I think the thing to factor in there is, how soon would you need something like frail care? How important is kind of guaranteed access to healthcare when you need it most? Because that's a real problem. People who are elderly and live in a normal home, not in a retirement village, when something happens to them and they need to get into frail care with urgency, one thing you'll find is, good frail care is extremely rare and there are massive waiting lists. And then, being in a retirement village where you've got guaranteed access to frail care that you've already checked out yourself, would be a real blessing. So, I think it's health and longevity are big issues there, and the probability that that if you're going to have health issues or you already have them, then perhaps moving into a retirement village is really prudent, and doing it when you decide under your control.
The critical issue here is they're 60, and 60. 20 years ago, 60 was very old. I'm talking, Suddenly, it doesn't seem that old anymore. And it's not old. It was never old. But people are living healthier, longer lives, better healthcare, better everything. And so you've got more options open to you. And I don't think you need to get wedded to any one of those particular strategies anytime soon. So it is a time, I think, to experiment a little, as you suggest, Warren, with rental. What about rental in perpetuity? I mean, so often, and I think we've got a minute to just touch on this, rental is cheaper than owning in many cases. Is rental preferable or less secure, perhaps? Maybe you don't want to have the vulnerability of a landlord when you're 87 and you're suddenly getting chucked out of your house because your landlord has decided they want to live in it, for example? Kind of
speaking my language, I can't emphasize strongly enough that I would love to be a tenant for the rest of my life and never own a property again. I think, doing your due diligence on your landlord and forming a great relationship with a good landlord who wants tenants for decades is the way to go. But for other people, owning a property and owning their home is kind of a source of emotional security, and good luck to them. But I think renting in perpetuity is really not a bad idea for a lot of people. And the insecurity of a landlord moving you can compensate for that by doing due diligence on landlords that own a few properties, that want good tenants, that do this as kind of a business. You don't just have to imagine that only one kind of landlord exists and that's the one that's going to kick you out in a year's time. There are lots of great landlords with great relationships with tenants for decades.
Warren Ingram, I think it's time to revisit that as a topic one of these days as well, in terms of the sense of owning versus renting. Good debate. Thank you, Warren Ingram. Co-founder, director at Galileo Capital, personal financial advisor Warren Ingram on a Thursday night.